All right. Thank you so much. All right. Thank you so much again being with us on this Sunday afternoon. And I really appreciate it. And I know this is the first time we're together. By the way, the markets have opened. So eventually, maybe we will have a Sunday session, maybe even do trading together some one of these days on Sunday. So but I'm very appreciative, and I hope you all had a great weekend, and hopefully we'll have a wonderful week ahead. So we do have a jam-packed event today, so I'm gonna go through things, some of the things maybe a little fast, but there's a lot I want to share with you. And as always, we'll start with the reviewing what is happening with our economy, what are some of the upcoming things next week, and then the meat of it will be the markets. We will review the markets, what happened last week, what to look forward next week, and the weeks to come. Uh, and I've got a couple of lessons of the week, which I hope it will be useful for you. So I will be going over that, and then I will have, as always, my trade of the week. So
Bob just taught me about an iron butterfly spread.
and all right, with that in mind, let me start with our usual economy. So there's a few things are happening with the economy now. With October upon us, that as you can see, the September is it was really fast. At least for me, it just went by. Tomorrow is already 28th of September, and it went by fast. Election is coming upon us in less than 6 weeks, and with the end of the September comes the as far as the election time comes with the campaigning for the representatives. So a few things have happened. Number one is there are new cases of COVID in South Korea, which they had been handling that well. One of the first ones that they really did a good job, but there's increasing there. And also Eurozone has been affected very much. This is, I think, the highest numbers they've had since the beginning in January. And Russia is a lot of cases in Russia and Spain. So that has been a concern. So all of a sudden, while we were looking at the light at the end of the tunnel, things are with the fall upon us. It is has put a grind in what has happened with the ECB's chair. Lagarde is going to speak in the morning in Europe, going to speak again on Wednesday as far as the monetary policy. Our end here, besides the presidential election and the debates, what we have at Congress, I believe they're going to, after 1 week, they're going to start campaigning. So there's no news. What is happening with the fiscal side of the things? What is going to happen with a lot of businesses? They still have about $300 billion, I believe, unused funds. And October 1st, a lot of airlines they're gonna furlough, but they're gonna let their employees go, and they could use some of that money. So I believe in next few days there might be a lot of negotiations because otherwise that's it. So that's again, this has been an amazing year. There's so many balls in the air with with COVID, with the election, with the tariffs, China relationships. On top of that, the what is happening from the monetary, fiscal, and then icing on the cake is now we got the Supreme Court, and so this is a lot going on. So with that in mind, let's see what happened last week, and then we look at what is going to happening next week besides this the fiscal side of things. As always, I like to look at the Department of Labor's and then the First Trust Advisors numbers. I did stay. I stayed in a hotel for the first time Friday night, so it was interesting to see how the things are working. The pool was open actually, and nobody was in it. Like my boy and his friend, my son and his friend. They did enjoy it. It was a warm pool, and but no breakfast, no dining. Everything was closed. So But it was interesting to see that there was some restaurants were open, wineries were open, so it was good to see that. But still, there's a lot of places were actually closed. So, and that's why I like these numbers. Again, they give us raw numbers. Again, the big concern is always the initial jobless claims from the previous week. Um, they still, these are big numbers when you compare it to the past. And then the hotel occupancy is still not there because again, with the rooms not all available, the occupancy that even the restaurants, a lot of them outdoor, and then even the place we went was like indoor, but a lot of spacing. So it's all about what is the average daily rate, how they're gonna make the money, and as you can see, the TSA still not much activities, and people still not flying, and so that's what is affecting all the airlines. So what's going to happen next week? What we're going to do, what we're going to see is, besides the ECB chair, we do have, as you know, the first Friday of every month is the non-farm payrolls and the earnings, and it's a big deal, and we'll see how this time the numbers are going to come out. So that's something you should look forward to for February, which comes Pacific Coast time is at 5:30 in the morning, 8:30 East Coast time. So that's important. Today, what I'm going to talk about from the economy, as far as the economic side of things, is it's about the future. It's about the again, COVID came from nowhere, but we've had these large deficits. We've had a unbelievable amount of debt, and as far as I remember, it's always been a question, but the markets, because of the growth they've had, they've kind of pushed aside. They've kind of, again, with the asset appreciations, that has become more of a remedy for these deficits, but still with the lower interest rates, uh, eventually the governments have to confront that. So this is from the Congressional Budget Office, and this was from last year. Actually, these numbers came, and just to show you, this was as of 2019. This was they were projecting for 2020 and what's going to happen. So obviously, the biggest revenue is their taxes. So this is what they were projecting. That's what's the taxes going to bring. That the net interest, which is our debt, the defense, and our biggest, as you can see, the biggest chunk of the spending comes from the mandatory spending, which is the Social Security and Medicare and Medicaid, and obviously the federal pension. So this blue, you can see it's been a big part of this, and we still have had problems keeping up with that. So imagine when you fast forward to this year and you look at what happens to what has happened to us, how the congressional, the CBO is going to look at things. This is what has happened. Now, there's a couple of things you can see. There's a big jump in this social and mandatory spending, and you can understand why. And the interest rates, as you can see, that the net interest was obviously lower. But going forward, we still have this big obligations, and the tax revenues obviously went down this year, but they're projecting even bigger revenues coming up. And how is that going to happen? I mean, when we had the 2008 recession, what happened was they are projecting that, and I will take to the next slide. This is what happened in 2019. This is where the revenues comes for the government. The individual income tax obviously is the biggest part of it, then the payroll tax, and then corporate income tax. Now that we were up 4%, this year we are down 4.8%, but the projection is by 2021 we're going to be only down 1.2. By 2022, in 2 years, it's going to be actually a big increase of 14.8, higher revenues coming from the individual income taxes. So The question is, in 2008, it took till 2013 to get the growth. So we are kind of, I think the CBO, there are a lot of smart people there, but I think they are overly optimistic in a sense that thinking that 2022, we are going to be up to 14.8%. And after that, we're going to continue. We're going to have the growth GDP of 2%. So these are concerning because in the meantime, the debt is growing. Somebody has to pay for it. So one of the things is with all this, if whether the new administration comes, whether the old administration is in, there is going to be some big decision making. Now, for instance, if there was a new administration, as you know, we did the corporate tax, we dropped it to 20, and now if new administration 21, we go to 28%. How is that going to affect the whole structure of the tax revenues? Granted, it could go up a little bit, but are the how the stock market going to react, and what is going to happen for the profit side of the obviously the companies, the net profits, but also on the other hand, we went from 35 to 20. Is that a big deal? But when you have slowdown in the economy, these things actually play a big role. So we are not coming from we don't have the upper hand. We are coming from really a deficit. So increasing taxes, is that a remedy? And what happens with the social benefits and again employment? So this is the optimistic numbers here, but these are the things we have to be watchful, and that's what you have to really think about, really working the different ways, not only from the point of view of your financial management, but really have to be concerned about your tax management to kind of work on where the government is going to come up with the tax revenues. Are they going to be creative? Are they going to go to 401ks and retirement plans? What is going to happen as far as maybe limitations on some of the things that you were doing as far as your retirement side of things? Would some of the tax exempt accounts will be maybe taxable, and obviously the tax rates, if it the wealthy, the wealth tax comes into picture, or is it going to be the high net worth, how much of that is going to affect? So these are the foods for thoughts for your future, and that's what I think. um, we really don't have an easy solution. The only thing is I've been talking about last few months that we are resilient. We have this entrepreneurship mind. So there's a lot of, again, there's a lot of opportunities in places that we never would have thought of. So there is that spirit is going to be with us, but it's going to take some time. So in the meantime, these are the realities. And one of the things I shared with you many months ago, once in a while I go and look at the US debt clock, and I mean, these numbers are staggering. I mean, I just did it, I think, a few months ago in March or February or March when we were doing a presentation. I looked at this. It just, you have to remember, this is just a US national, but you have to remember there's a $3 trillion of local and state debt in the municipalities. That's $3 trillion. So we have all these concerns. So don't want to be on the negative side. I just want to give you something that you have to be concerned with. So we have to again work on our budget, make sure we are doing our tax planning the right way. And that's why the investing is, the more money you can make right now, the better it is. So you want to have that cushion, and that's why these classes, again, I'm hoping to give you maybe a little added um, uh, benefit of getting maybe in, additional income from other avenues. So besides your job or employment. All right. So that's as far as the economy. So watch for Friday with the unemployment numbers. And so let's talk about the markets. Let's start with the psychology again, with the sentiment. As you recall, in August, we were looking at these numbers and we were really overstretched. It's amazing how the rubber band works or the universal laws work. And we were talking about that, how the there's just so much positivism. August was one of the best months in almost 20 years. I mean, the best August we've had in 20 years. We talked about these Robinhood um, retail traders, and here comes September. I did mention usually Septembers are not very kind to the markets, and so we've had some cleansing. So we're getting closer to the neutral zone, and sometimes that doesn't mean it's completely good news. So usually these work on the extreme. So if you're neutral, that's not good or that's not bad. So these are the areas we want to look at to give you the direction. Other than that, so that means there's been some complacency have kind of erased, and some fear has come to the markets, some reality to the market. So that's where we stand now. The same thing with the CNN Fear and Greed Index. You can see not just long ago, actually, we were at 78. A month ago, we were at 74. Now, there's a little sanity's back. And again, that doesn't mean that the markets cannot go much lower. All it says is that euphoria has lost its, at least for now, has lost its impact. So last week, what happened was, majority of indexes were down. The Dow Jones Industrial was down 1.75. The week before, if you remember, they were mostly flat. S&P was down 0.63, and then Nasdaq was actually up. So the technology stocks did better. And again, you can see that S&P is like somewhere between Dow Jones and the Nasdaq. So usually that's what happens. It's a mixture of those. Um, in the meantime, if you see what we've had, that the only positive ones were the technology. The Nasdaq was up 1.1, and the utilities, which is a more defensive sector. Everything else was down, especially when you look at the small caps. They were down 4%, and then the value in the more general market, like um, the New York Stock Exchange, the companies, they were down actually 2.71. And when we look at the advanced decline, so you can see there was like 4-to-1 decliners. As far as the dollar, that was a big news. So we're going to talk about that because the dollar got stronger. As you know, it had a horrible 2 months, and then a few weeks ago started consolidating and then started moving up in the last 2 or 3 weeks. The treasuries, which are important, they were kind of flat. They're up a little bit, and then crude oil, again because of the COVID case, it has been affecting the demand, so it was down a little bit. And then the gold had almost a loss of $100. So gold, we will talk about gold in our charts. So when we look at the technology and we look at the sectors, you can see again the technology was the winner last week, followed by the utilities. Other than that, you can see everything else is in red. Energy being the worst performer, and then financial not far from it. So what is happening with financial is there's a lot of concerns with the what is happening with the again, the defaults is going to be about 17% of, you know, uh, retail owners, and there's going to be, as far as more closures and more defaults in mortgages. So, on top of that, again, there is the concern with the election. If if the Trump administration stays, would that be less regulations? And then Biden's will be more regulations. So those are the concerns on top of everything else. And besides that, in this week, again, the analysts came and downgraded Citibank and Wells Fargo. A few financial services got downgraded, but these were the two big ones. So there is concern. And October usually is not a kind month either. So we'll see. But this is what has happened. As you can see, for the um, past month, everything is in red, energy being the worst. And then we look at the communications and we look at financials. So it's in the technology. But let's talk about last few days. So last week, if you remember the previous week, and I'm trying to keep again the charts kind of again steady, so you get used to these charts. We have the Bollinger Bands, and what we can see is that was the top of the Bollinger Band. This is our S&P futures, and I had, if you recall last week, we said every time the Bollinger Bands is touched, the bottom, the first time, the markets like to go back to their 18 or 20-day moving average and kiss it. And if they are oversold, then they will have another coming down. So in this case, you can see we actually last week came to our 100 moving average. And that's where, again, a lot of money managers, a lot of algos, with the futures especially, that's the next support zone. And also when we are outside the Bollinger Bands, or we're touching, going outside that, if you recall, whoever was short, they cover. Again, you're talking about institutions. And so they don't necessarily have to be the buyers, but they do cover their shorts. So in this situation, our stochastics, we are embedded. What that means, we are still an oversold. And oversold doesn't mean, oh, it's a good time, there's a bargain coming up. Oversold basically could be oversold for a long time, as we can be overbought for a long time. So this doesn't mean it's a contrarian, you're going to start buying. But it does, if it comes up and goes over 20, then there will be more confirmation that it's a good time to buy. But what we saw was a rebound from the 100-day moving average. So there's a good chance we will go maybe kiss the 18-day, in this case, moving average, and see what happens. So, but we're still not out of woods. If you recall, it goes back weeks ago, and I had mentioned, every time we were over 18 days, we did come back and went over it, especially with Nasdaq. In this situation, this has been real. It's been real selling going on. The other reason you can see there was a bounce, this is from the linear regression lines. And what happened was you could see that we were overbought, and then now we were oversold. We hit the second, or the 2 degrees, the second standard deviation on this. So it was definitely time for a rebound. Also, the squeeze, the color has changed. We are not in the squeeze. We had one dot, so we still have the momentum, but the momentum is losing its power. So we changed to yellow. So this could be maybe more of a day trading you've got to watch. I'm not sure we are completely out of woods, but the odds are more in favor of going short-term long than actually shorting it at this time. So, but again, we need confirmation. So I will, at the end of this presentation, we will have some more ideas about next few months, what I think. NASDAQ was, as you recall, was the strongest one. But again, look at this for the last, since, March, we will only one time, every time we sold off, we came back above the 18 days. And in 20 days, it's even more visible. But last time, when September came, when we sold off, we could not break above that. So this is real. This is where this, whether you believe in technical analysis, whether you believe in moving averages, this is what, it's kind of a self-fulfilling prophecy, in a sense that the markets respect that, the algos respect that. There's a sell-off. And again, we came very close to the 100-day moving average, the lower Bollinger Band. So this 18-day is going to be a battle zone. The only difference between this and S&P is we actually getting out of embedded zone and getting to oversold. So this could continue. At least we go to 20. So we'll see how the NASDAQ behaves this week. It's an important week. And if we break it and confirm 2 bars above that 18-day, then there is a fresh buying coming in. But we need that confirmation. Don't rush into it. The transportation has been unbelievably strong. And what has happened in the meantime, the Bollinger Bands have been narrowing. granted we had sold off, but look at how narrow the Bollinger Band is. So we are coiling right now. So we'll see how the Bollinger Band is going to behave next week with the transportation. We are in the lower side of it, but again, it's a very narrow. So again, there's a lot of energy being coiled. So let's see which way that the market is going to go. And they, from the dot theory and the transportation, they kind of lead. So in this case, let's see what's going to happen. Um, Russell 2000 was the weakest last week, and for many reasons. We mentioned they have financials, energy stocks, and they, if you recall, that 1601 has been my resistance. I did short the market. I bought the TZA. I've been playing this, been shorting it. Tried to break above the 18 days, could not. Now it's parked right on 18 on the 100-day moving average. So we basically again outside the Bollinger Band, probably is going to try to come in. Right now, again, the short sellers are covering. So, but I don't know how much of a fresh buying is coming in because we still are embedded in an oversold position. The 10-year note, I mean, look at how narrow this is. So it's more of a maybe Fed is controlling the rate, so not much is moving, and that's why you see even the 100-day moving average just flattened out. So there's no movement. So it's important to watch this. And then this is the big thing. So the dollar has played a huge role in a lot of assets. So what dollar has told us that there is obviously nervousness, and although fundamentally there was a lot of things going against it, which you could see from what happened from May and June and then July. But we were stabilizing last 4 or 5 weeks, and now we broke above the 18-day, and now Bollinger Band again. You can see that this is the neck. It was really coiling, and then we broke above that. So why it's important to know about the dollar, because a lot of commodities actually follow, and that affects them. And this will explain why, for instance, gold had such a big drop. Gold was actually narrowing, sitting right around, um, its 18-day moving average. But I had mentioned, I know, talked to a couple of you and said, 1800 would be, I would go buy, it would be a great zone to buy. Right now, you can nibble. You can, if you want to do selling puts, this might be a good area if you play GLD. It's supporting, but we're still not out of woods again because we're embedded. So once this turns around, the fast lane comes back up, goes over 20, that would be a good time, some confirmation. Right now, there's still a battle to hold this 100-day, 1860, 1855. That would be a good zone. If it breaks up, then this is a good time to maybe just do a little vertical spreads if you like to do, to back at least to the 18-day moving average. And the same story goes with silver. Silver was a little stronger than gold. And actually, I started trading in silver, started actually buying calls and puts, selling puts and buying calls, because I felt, 22 would be a perfect place, and 20 would be a very good place. We still not haven't gotten confirmation, so I jumped the gun. But I mean, I've been bullish on silver since March, so I think we are really way outside the Bollinger Band. So that's just a food for thought. We could go down, but depending on the dollar. But I think silver has more potential, and it's much lower than its 18 days, so there's much more room to move back up. Bitcoin is another, again, kind of a dollar play. Now, Bitcoin is interesting because we had such a nice move. We hit the top of the Bollinger Band. We had the squeeze. I think we talked about that, and then we let it go. And of course, you can see again that 100-day and the lower Bollinger Bands became support. The difference between this and, let's say, gold and silver, we were embedded, but we are out of that. So this is oversold. So that means if we can break above this 18 days, then the momentum will change and we will go up, especially if we go above the 50 on RSI, the relative strength index. So this looks good if we can keep up above this 18 days. I'd like to have two confirmations about that. Um, let's talk about last week. We talked about the expected move, and looks what happened last week for the. We mentioned about Nasdaq being the strongest, so I go with QQQ. The previous week, if you can recall, the open went above the upper line, but then immediately got rejected. Then we went and hit the lower boundary and we stopped right there. This was last Friday. This past week, it was, you can see how nicely we stayed within this confound zone, which was our expected move. So for next week, these are the numbers for the next week. So you can see there's more optimism coming back. So here is a little higher low. So in a sense, that's what, again, the markets respect these numbers. The same thing we can see in the financials, for instance, and financials have had big trouble. So this one, we went way outside from Monday. We never were able to recoup, and I will talk about that. It happened a lot with the financials, and it happens with the um, Russell 2000. So what that tells us is there's a lot going on. There's a lot of pressure on the financials. So whether we're gonna, you can see Friday and Monday, Thursday and Friday, we try to get back. And is this, are we gonna respect the lower boundary, and maybe hopefully if you want to have some rebound, we can have a rebound, or the pressure is just too much that we're gonna stay below the lower boundary. The same thing you can see happen in gold. With gold, we really have gone way outside the lower boundary. So it's been 4 days, so, and the 5 days actually. So is this a good time to maybe with this respect? But again, these are the expected moves. So for next week, we should respect that and watch these numbers. So if, let's say Monday, we go down to this area and then bounce back, maybe that's a good time to use for purchasing some gold. The silver was the same thing. Look at how far silver dropped. One thing about, again, gold and silver, the precious metals, once they start going, they really go. They respect the round numbers, and they like to, gold likes to move in the $25 increments. So usually, again, I used 1860, 1850. They respect that. So usually if it hits 1850, turns around, likes to go back to 1875. So these are just some of the numbers I've used in the past and has worked. As you can see, I do have some limits on my gold play or in silver. So let me talk a little about long term, so talking about history and what is outlook. It's not my outlook. I'm just gonna give you uh, some facts from the past, and you can be the judge of that. But we talked about in a short term, it looks like we might have a little bounce. But what happens in the long term? So this is the numbers came out from the uh, so we have the commitment of the traders, and this is for the large speculators. This is the first time we've gone so far since 2011. Actually, we are much lower than that even now in the last 10 years. These are their net positions in S&P 500 and NASDAQ and Dow Jones futures is at $49 billion. They're short positions. So what I did, I looked at the numbers and I said, okay, well, what, we've had that in the past, and it is that contrarian? Should we use as a contrarian these large speculators, or it has leg? So basically what we want to do is, all we know is this is one of the largest we've seen, and there's a lot of, again, large speculators that they are, they control a lot of money. They betting against the markets, whether it's election or not. So I went back to 2011 and I said, what happened in 2011? So around this time, we had a large number of, again, that was about $30 billion in short. So this is what happened after that. That's in August and September. And in October, gradually we started, we had another leg down in November, and then we started moving up. This is 2011. But I want to know if there was any catalyst for this. And obviously, it was on August 5th for the first time when the S&P downgraded U.S. sovereign debt, and that was August 5th. So this is that waterfall, and it took us a lot. It was like really, I remember that day, and I was actually trading, and it was like psychologically, it was devastating in some ways. But then things, look at what we are now. So this is just a food for thought. This is where we were. We did have this before the news came out, so we were there were a lot of short sellers, whether they knew not. So, and this is what happened. I think we had a flash crash at the same time as well. So, but that's the number to watch for. And so that $49 billion in short. So, just put a little note. Just added to your some of the concerns that I have for the long term as far as the markets go. I went back on a weekly and I looked at the market again since 2011. Um, the trend line, just not scientific, it's just a trend line. And I noticed, we in August when we hit the all-time high, we hit that trend line and we got rejected. So that's becomes our big resistance. So whether we're going to have another all-time high, we need some digestion. So that's where we stand with that. So that's another concern that I have. The third concern I have is with the Dow Jones Transportation, as I had mentioned to you, that it's been pretty strong. It's been a good leading indicator. You can see what had done since March, and obviously there's some good reasons for it. You look at the UPS and FedEx of the world with Amazon, everything being online. So that's a lot of movement because of people need the merchandises and all that. So, but what concerns me right now on a weekly basis, we have developed again. This is just one indicator. It's but the shape of it. This is from the candlestick point of view. This is something called evening star, and evening stars are pretty strong indicators. So we have a doji, and then here we have a hanging man. So if next week if continues, that's not really good news. I mean, that will take us down to this area, to the support. But also the transportation has been a leading segment of our market. So that's again, it gives me a little hesitations to be really aggressive buyer of the markets at this time. The fourth thing I looked at was the Russell 2000 or IWM ETF, and I looked at again. I saw like the previous week we were outside these boundaries. Last week we are in the other way. We're down 4%. If you notice, we've been kind of orderly and most of the time, but I went back and I noticed in January and February, we were getting these really wild movements outside boundaries, and that was when the correction happened. So I'm just putting some factors out there. This doesn't mean that we're going to have, I don't believe we're going to have a crash or anything. I'm just looking at some of the things that concerns me. The volatility is obviously there, and so that plays a role. But this is the expected move now. Let's see what happens with IWM this week. See if it can be contained inside that. All right, so that's about the market. So I thought to share a couple of lessons with you this week, and one of them is about the VIX. So we talked a lot in extent last week on the VIX. Why the markets were dropping, but the previous weeks, why the VIX is actually going down as well. And I mentioned about again the implied volatility on the calls, and people were selling the calls, and but they weren't buying anymore. They were more concerned, and what they were thinking is that they weren't buying the puts either. They were just buying. They're not buying calls. So that kind of squeezed the volatility. But one of the things we do, as you know, the VIX is a 30-day average, all the average of the futures of the S&P options, the SPX. So that's 30 days average. They look at the puts, they look at the calls, they look at what is the implied volatility of all of those, and they come up with 30 days. but you also have access to many other volatility indexes and different asset classes. So I want to share with you um, some of them that you can do it on your own. So this is VIX. You can see, this is where we were. There was a big drop in the first week of September. Then the markets were dropping, but so was VIX. And then you can see we hit in this case 200-day moving average got rejected. We have a 50-day, 20-day. So this is the VIX, which everybody's familiar with. But there is also a volatility index on NASDAQ, for instance. So you can actually study your own. You can see, oh, the S&P VIX actually broke under 200, but there's a lot more volatility with the NASDAQ VIX, for instance. So there's more movement. If you want an option buyer, you look at the implied volatility. This can give you some ideas what the market thinks about, the 30-day from now. What is the options volatility for that? Apple has its own VIX. So you can see, this was a pre-split, what happened, and the split happens, and that was the height of the volatility of Apple. So we still it's pretty up there when you compare it to where we were in June. And so I just want to give you, so these are the things you can do on your own. I want to have the symbols. You can go to CBOE index and website and find all these, but I thought I'd just give it to you how to find the graphs and the charts. This is for the gold, for instance, gold index. We have for the oil, crude oil. And by just looking visually, you can see when there's like a squeeze, this is just a volatility of the index. So like let's say euro, you can see hasn't moved much in the meantime. So there's been going on. This is the volatility of the movement of the euro. On the other hand, you look at emerging markets, they're all over, up and down, which makes sense. Now, S&P not only has that 30 days, they also have a longer term, the 6 month. And based on these, you can actually have the ETFs built. There used to be, there's a VIX, VIXZ, VIXC. So then you have WI, the VXX. So these are all based on the longer term, the less volatility in it's supposed to be. So, but these are the things you can compare to see. We have a 9-day VIX, we have a 6-month VIX, we have a 3-month VIX, we have a 30-day VIX on S&P. And you have on Dow Jones Industrial Average, you can follow. And then this is the volatility of volatility, which is very interesting. For the first time, we actually gone below 100. So that doesn't mean that, we are out of the woods and it's like there's not going to be any volatility. But it was interesting. We got a little squeeze here that it's, the volatility has kind of slowed down. So 100 is the mark we use, 100 to 110. This is the volatility on Russell 2000. Then the rest they went, so I used the trade station. Now this is for the XLE, the energy sector. This is for Google. We can have the volatility of Google. We can look at Amazon. This is how Amazon is, and then the VIX of Amazon, and then there's a VIX of SLV. There's for Goldman Sachs, there's for IBM, for instance, GDX, there's EWZ, which is Brazil. GDX is the mining stocks. You also have FXI, the VIX of the Chinese index. So there's a lot available for you. So this is, again, the whole idea is to have edge, right? So by studying this, you can see what is the market predicting as far as the future movements. The second lesson I want to share with you, I think quite a few of you use Thinkorswim. So I thought this would be a good idea, maybe to share some of the ways that you can find some new opportunities and how you can really work as far as purchasing the options, selling the options, doing the vertical spreads we talked about last few weeks. So it has so many information. I like to do just a whole webinar, maybe just a few hours. Just you can have a boot camp on things that you can do on Thinkorswim. So one of the things I thought to share with you, which I shared a few weeks ago, it was on Marvel, right? And we looked at, there was an unusual option activity at it was like 49 or something. So I saw this again coming up. This time was at the 43, which is again out of money because Marvel is at 37.90. So this is where you go on the trade side of the thinkorswim. You type in Marvel, and this what it comes, the underlying. This is the information for the underlying, and then you can choose the option month or week that you choose. So this was October 16th, which is a monthly expiration. And you can see that the market makers are expecting this is going to go up $3.29 or down. So that's the expected move. And if you notice, like 3 plus $3, that's $40, maybe $41. But yet, there was a huge volume came in at $43, which is outside this expected move. So now the radar goes up. So what's going on? Why the open interest was only 1,135 and we have 11,804. So on your thinkorswim pane, when you go down, you can see there's something called the statistics for the today's option. So this is from Friday's close. So how do we read that? So let's work on that and then we go to the right. So number one is the implied volatility. As you know, implied volatility is one of the top three indicators of the price movement of the option. So the 52 weeks implied by the high, as you can see, this tells you it was at this number. The low was at this number, so it was 1.12. The low was 0.274. Now, how do they come out? This is the important part. What they look at, they say, well, current implied volatility is 45, 65%. So compared to, so if 1.1 is in one end of our criteria, that 0.247 is on one end, where does this 45% implied volatility? You can see it's closer to the low end. And that's why they come up with the 21 percentile. So that means the implied volatility on absolute way, you will look at and say, oh my God, it's 45.65. But it is relative to its movement, it's only on 21%. So what that tells us, if you want to be a seller of this or the buyer, well, most likely this is not overvalued based on implied volatility. So you have to be careful that the volatility is pretty low. Maybe it has more room to go up than go down. So that's just a food for thought. So this is a good indicator for you to know whether you want to be on the purchasing end of it or is this a good time. So obviously, if you were like an 80 percentile, then you would say, well, we are very close to the high end. This is a good time to collect the premium. You can play, we will talk in the future, you can play the gamma play. So which is, and then you can play the volatility of volatility. So what we could do here based on that, and then you look at the historical volatility and you can compare to implied volatility. So it's all in here. And you can see on the historical, it's still low too, 24%. The last thing is, and it's something called VWAP, right? So the VWAP, I use that a lot in futures. So eventually, hopefully, when we get to the futures market, even if you don't trade, it will be good to see it in your dome and see what that means. So VWAP stands for volume weighted average price. And what it does, it actually looks at the price and takes the volume into consideration. So let's say if you had 1,000 shares traded at 10 and maybe 5 at 15 and let's say 20 at 8, they put a lot more value on that 1,000 shares than let's say 5 or 20 or 10. So basically it averages it out. And this is one of the ways big funds and other things, they look at this, and that's how um, they use algos and logarithmics buying, and that will take them maybe a month, 2 months, whatever it does. So because they don't want to push, they don't want to put tons of volume in there. But by using your VWAP, you can see what is the average price based on that volume. and it is a good indicator, because if you're under the VWAP, that means usually you're underpriced. So that's more of a value. If you're over VWAP, then you're overpriced. So usually markets like to come back and normalize themselves. So again, you will see that a lot in like S&P futures, but you can do it in all the stocks. If you are buying, you're in and out of stock, this is a good indicator. So right off bat, this can tell you that, okay, the rewrap of the Marvel is at 38.06 for that day, Friday. So we are kind of a little undervalued. So if you were thinking of buying it, maybe a lot of people actually buy lots of volume and they sell it the same day. They're the frequent traders. So, but this is a good indicator. So that's explaining what this is. Now, this is a very attractive, and if you haven't seen it, this is our sizzle index. So basically, sizzle looks at all the options traded on that day on this stock, in this case, Marvel. And what they do, they compare it to the average, and they go back, I believe, 10 days or so. So they look at what was in the past, and they look at that and they say, compared to that, where do we stand? So in this case, the sizzle index is 1.26. So that means it was 26% more options were traded than the average past, I believe, again, 10 days. I'm not sure, but I think that's what the average they use. But they also look at, they say, wow, 1.4 is like 140% relative of their calls. So that means there are 40% more calls were traded. On the other hand, the puts were lower. They were only 74% of puts. And then the volatility is a little bit higher than what it has been. And the stock sizzle is within, it's pretty average. So obviously it's a movement of the stock. So the put call ratio you can see is a lot more a lot more calls were purchased or traded, not purchased, traded than put. So far we know we already got this 11,000. So immediately we get curious and say, well, we also know there's a lot of options being traded on the call side than the put side. Now, is that positive or is that negative? Because immediate thing is, oh my God, calls, they're gonna push it up. So this is the next thing you will look at, is whether all these calls or puts were traded at the bid or were they traded at the ask. Majority of times you do it at the in between, right? So, and I've taught last Wednesday, I said, try to get options in between, especially the liquid options. Easily you can meet that. So, but with this, if it's bid, when it's bid, that means there's a selling going on. Because if I'm a seller, I want to get as much as possible. So when it's asked, there's a lot of buying going on. So then in this case, you can see there's a 61% or 51% was at the bid, and only 20% or 29% at the ask. So right off bat, it tells you that there were a lot more, maybe they were selling these calls, not buying these calls. So that's just the food for thought. And then the puts, they ran a lot, but the puts are, you can see there was a lot more buying on the put side. So this 11,800, maybe somebody's selling calls on this. Maybe it's a covered call. I don't know, but it's not, doesn't necessarily mean that somebody's really bullish that they want to buy this 11,000 contracts and 43 um, options. So it's interesting. Usually these are the higher numbers. So it's 18%. It's pretty low for the in between. And then you look at the deltas, and then you can see that the delta is, the majority of this is on the 0 to 0.20. So that's really out of money deltas. So somebody is going out of money. You can see there's 14,000 contracts, which is 62%. That's out of money. So there's not much at the money and not much in the money. Usually at the money is like 50, 60 delta. When it's go higher than that, it's in the money. So these are some of the things that hopefully it helps you to understand. Just having unusual option activity doesn't automatically mean okay, it's time to buy it. Now, the next thing you look at is we talked about, I think right around here, we talked about unusual options activity. And it was like around close to $50 actually at that time. And I mean, the options activities were happening. If you recall, we had this big trend line, and I had mentioned we might have a little um, digestion, and we needed to come down a little bit, and that's what we did. So right now we are consolidating, so it's an interesting place to be. So this is something you want to look at, see if just selling at 43, that doesn't mean anything, because that doesn't mean that we are negative or positive, just somebody's collecting the premium most likely. But also we want to look at, again, that the um, earnings is not coming up till later in October. We also see there's a squeeze developing here. So something is going to happen. So between that, the squeeze, we don't know which way. We just know the squeeze is developing. We are in a one standard deviation. So this is, again, food for thought to watch it. So we don't have really concrete number of things. But this was, I thought, just a good case study. Well, let's do one more case study. So because I also looked at, and I'll tell you how I found this. This is Coors, Molson, Coors, the beer company, which is TAP is the symbol. Then I noticed that, again, the price is at 32.65, and we have on the put side of things, what we have, which is really out of money, it was 22,207 contracts were traded on Friday, and open interest was only, this case, 695. So that's, again, interests me to see what's going on. And we can see there's $2.37, let's say $2.30 movement. So it's right around that expected move. So when I looked at this, again, the options, the it is pretty low end of it. It's a 22%. The rewrap is right exactly where it is, 32.65. So implied volatility is 41. But I'm looking at the sizzle index. This is pretty big. There's a lot going on. And then I see the put sizzle index is at over 4. So what's happening here? In this case, we're looking at huge number of puts, but 21,000s are at the bid. That was done at the bid, and only 2,400 at the ask. So somebody now doing this selling puts on this. So, and again, we can see this is out of money. It's like a lot are happening out of money, which it is. 30 is out of money, so the delta is low, and you can always change this to find out what again, the information you want on the pane. But so this is, so the tap came. Now, how did I find tap? I think, by the way, looking at the earnings is before that, I mean, after the October 16th. So we are not in a squeeze, but, it's still momentum is to downside. So the market is going down. So getting closer to the second standard deviation, but this was the low. We've been $32. So that's, again, food for thought from that point of view. So how did I find this? And I think I shared this with you before on scanning. So basically you go and scan on Thinkorswim, and what you do is called stock hacker. So you go to that, use all stocks. But a lot of times I like to use, you can choose everything you want. S&P 500, you can do Russell 2000, NASDAQ, everything you want. So I just chose all stocks. One of the things I do is right here, when you press this, I didn't show this, but always reset I reset my scan. So it's okay. It asks you, are you sure? I say yes. So what I want looking at, so on this side, you can even get rid of always 3, and you can add more, but you can get rid of this, like if we wanted the volume, but I kept these 3. So the first one was the sizzle index. So I'm looking for things that are really outside the unusual. So 1 is the norm, right? So I went with 3. So I said, is there any stocks that their sizzle index is over 3? And it automatically brought me to 5. They gave me the 5.9, but the minimum is the most important thing. So it found 107 after other criteria, because I looked at, I want to have a large volume because I want to have options on them, obviously, and I want large volumes. And I didn't want anything lower than $20. Even $50 is better, but $20 at least. You don't want to have a $10 stock with the options. So basically, that's what this $20 comes from. So based on that, I came up with 10. So these are the ones, and I chose tap. So this is how I found they have a large volume. You can actually add, when you go here, you can add the sizzle index. If you can do a lot of things. That's why we need another class. You can add any, as far as criteria that you want, you can put it here. So I chose, I said tap. So let's say you did the scan. So how do you get to where I got? So all you have to do is just do a right click on tap. The right click will bring you to this drawdown. And then you just go to more info on tap and just click on it. And once you clicked on it, it takes you to trade. And trade will take you to the options, pane that we looked at, all the information. So I think this is, pretty a good tool if you like to use. Even don't have to buy options on it. You can actually do some prediction on, the direction of the stock if you want, and mix it with charts and also again with the options information. Okay, I hope that's helpful. So there's so much more to do, but I thought this might be of help. The last but not least is the trade of the week. What I had few trades, but there's a couple of things I do. Some of you know me. I do something called gap trade. And last week gave us a lot of good opportunities. So for the futures, it works really good. But you can also play options if you want to buy put options, or buy, if you want to buy the call options. In this case, like usually when there are like such a small gaps, so this was September 22nd. So Monday we have, um, let's see, this was Friday, this was Thursday, this is Wednesday. Okay, okay. So basically you can see there's a small gap immediately got filled. So if you're an option player, a futures trader, you know the statistics on your side. I usually don't do Mondays, but this is what happened. And I'm sorry, yeah, this is, yeah, I took a picture way before. So this was Monday. This is Tuesday. This is not only we hit the resistance and immediately covered that gap and went all the way down. And this is Friday. This is Wednesday. So 22nd, 23rd, 24th, and we filled that gap. So that's one of the plays that I do every time I get a chance. It's kind of a bread and butter, for the first half an hour. It's a good trade to use. The other thing I did was I did a trade, and I'll show you what was my trade. I was that was Wednesday's class. So I'm talking to Sean. As you know, Wednesdays we are here at 5. So I'm about 4:30. I put a trade, and I came to prepare for our webinar. And then I'm talking to Sean, and I said, Sean, yeah, by the way, I put some trades. It's on automatic. So we'll see by the time the class ends. We'll see what we did. And um, basically, I had taken that expected move. So this is Wednesday, and we went outside that boundary. And then, just based on statistics, again, you have to remember you cannot beat the markets, you cannot outsmart the markets. All you have is trying to use statistics and probability. So, probability for me was more of an emotional. I knew overseas they usually like to fade these things, and first they take it down and they want to push it up. So since we were outside this, and then I used the 30 minutes also, then what I did, I basically started buying futures, and basically then it was, I started at like 420. My class was starting at 430, 425. So I started buying, and then by the time the class ended, which was 6 o'clock, we were all I was all out of the um, my trades. So basically, we were automated. I do use one cancels the other. So if I had lost big time, that would have just gotten out. But one cancels the other is if you hit your profit, it cancels your stop loss. So automatically they just cancel each other. So basically that's what I did while I was in the class. But I also did silver and gold trades last week. So that was my logic for that. And the last but not least is this SPX expected move. Sometimes they're not exact, but they're close enough. So for next week is the expected move is like 82. And what that means is the bottom boundary would be probably around 32.16. The top is 33.80. Watch for the 33.20 on S&P. That looks like an important factor, important number. So if you can break that, that would be good. So, and then the 3200 is a big support. So if you can stay above that, this is your expected move. So with that in mind, that's all I can share with you. I hope it was helpful. And Sean, we can stop the recording and then start again, maybe for